Hey guys, so I want to talk about the market and investing in it. And I think we've reached a point where you have to be much more critical on which stocks you invest in, because ultimately we're having a tighter supply of money, which means asset prices won't just shoot up the way they were and the way we saw up until about a year ago. So this is obviously due to rising inflation that's leading to the rise in interest rates that the Fed's talking about, and also quantitative tightening. I want to talk about 5 critical rules that Warren Buffett uses when he chooses which stock to invest in. And I think it's extremely important now because we're at a time where companies are falling 10, 20%. And this ultimately leads to people maybe selling at the wrong times or not fully understanding, wait, why did I invest in this company? And then questioning themselves. And you ultimately end up reacting emotionally, and kind of reacting emotionally in the market is usually how you lose lots of money. So if you really follow these rules, and then that's how you go about investing, then you'll ultimately feel comfortable in the stocks you invested in, even in the downturns. And typically you'll see them as a buying opportunity and kind of seeing them on sale. And what they say is the one sale in town that people don't buy in is the stock market. So you want to come at it clear-headed with a structured way of finding those companies. So these are the 5 rules from Warren Buffett. I will go through each one and I will explain them in detail. As well, I would appreciate if you can like and subscribe to support the channel. Okay, so rule number 1, invest as an owner and not as a trader. So this is extremely critical, and this is how you're kind of coming at each investment decision. If you're planning on trading, then this video is not for you, and it's a totally different strategy. When you're investing, you're taking ownership in that company. So you can't just think of it as a stock at $100 hoping to go to $150. You really want to kind of know the company inside out, know that you're going along for the ride with that company, alongside it as a part owner of that company, and that it follows your values and your principles, and that going forward, even if the stock's not doing so well, you're still an owner of the company and you take pride in it, in the sense that you believe, and we'll get into valuation in another rule, but you believe that ultimately the company is going to continue growing, and by default that equals typically the stock price going, and it's really a mindset that you have to come at it. Warren Buffett always uses the example of owning a farm, that if every day someone comes to you and wants to buy that farm for you under value, you're not going to say yes to them, and you're not even going to really pay attention. You own that farm, and you're going to continue operating that farm. And in this case, obviously someone else is operating the business, but you're a part owner in it. Just because the stock price is lower, it doesn't matter. Really view it as a company, and that's what you have ownership in, and based on all the metrics and all that, what it's going to be later on. But you have to take out the mindset of the everyday stock price. Rule number 2 is consider carefully a company's intrinsic value. Now, this is an extremely important point. However, I will diverge a bit from Warren Buffett, and that's really because I want to incorporate growth stocks. So the intrinsic value of a company is really, you're going to look at what cash flows the company will bring in going out the next decade or so, depending on your investment horizon. Typically, it should be long-term. And based on that, you're going to work it back through a discounted cash flow or other ratios to what the company is worth today. Now, typically, how it worked is, back in the day with traditional value metrics, is, let's say you take Home Depot, you can kind of analyze what their operating expenses are, and from one location, this is the profits. So then if they build another location, what's going to happen? And then you can put a growth rate to that and all that. And it's very easy from there to see what the cash flows are going to be going forward. You kind of put the growth rates on it and you discount it back to today, and then you can see, is it above or below intrinsic value? When it comes to growth stocks, it's very different, because you're not able to do that one extra location will equal this. It's more these industries just expand way beyond what their TAM is, their total addressable market is seen as at the time, and it's really like an exponential rate of growth. So for example, Apple with the iPhone, you can try to model it out, but even at that point you couldn't, because Apple created its own new demand for phones because of the iPhone. And also then you add services on top, which they're making a ton of money from now. So, and Amazon started off with the bookstore, and then it moved on to full e-commerce, and then onto AWS because of all the data and all of that. So growth companies, you very much, I think, to get to that intrinsic value, you do have to do the metrics, right? You don't want to be investing in a stock out of hype. You want to kind of go through what those cash flows can be going forward, but you also have to put in a bit of a storyline, which is very much based off intuition, the management, which we'll get into in another rule. But you still need to have that intrinsic value that I'm investing in this company today because these are potentially the cash flows based on all this, even though it's not one-to-one. And that means in 10 years from now, this is what it's going to be. So the stock price is worth this now, which makes it undervalued. So I think with growth stocks, it's a lot more difficult to get that exact mathematical science value metric data, but you still need to understand what that company's worth. So if we look at a Tesla, you can take in Elon Musk as a metric of this is the innovator of our time. So that gives some more intrinsic value to the company, or the potential products that they could do in the future that gives some intrinsic value, although you can't really model them right now beyond just kind of the auto business at the moment. So intrinsic value, rule number 2. Rule number 3 is analyze management. And this is very important. Ultimately, like we said, you're going along with the company for the ride. For the next 5 to 10 years, you are going to be alongside this company, whether it's having ups and downs and the stock price is falling. The most important thing is to know who you're with in this ride. And ultimately, the management is kind of steering the ship. So you need to know that you can trust in them. You need to know that if they say something, there's actually something behind it, because many times they'll just say what investors want to hear. So you have to be able to weed out all this. And it comes to, again, intuition. You want to look at the ratings of the CEO on Glassdoor, how people talk about the company. You want to look at the prior experience of the management, and did they get stuff done in other jobs? Do they have skin in the game? Do they own a lot of stock? What's their incentives to do well? Are they getting paid out no matter what, even if they don't perform well? You have to really go through the management because they're steering the ship, and you're on that ship when you put your money in it. So make sure you go through this step because it could be overlooked. Number 4 is stick with a business that you understand. And I think that this is also, if you're investing in specific stocks, then you have to know everything about that company. You have to really be able to go in depth, because you can't just take advice from someone, because if the stock falls, then you'll be like, wait, maybe that person didn't know what they were talking about, right? And then you'll sell at the worst time, even though it could have been an incredible investment that was cheap and you sold at that period. So you need to kind of do all your due diligence. And if you can't do this, then maybe it's better to invest in ETFs. But ultimately, if you're investing in stocks, stick with businesses you know. For example, I won't invest in just a biotech company because it's just way beyond what I can comprehend. And if I was looking at biotech, and some people, they can't comprehend the exact different business models, but they can say, wait, later on, this industry is going to be huge. So I do believe it's going to grow. Then maybe you can look for an ETF in the biotech industry, and then you're not kind of latched onto one company and that company's specific performance. The 5th rule is find a business that has a real advantage. And I think this is really important when it comes to growth stocks. And this is ultimately a huge, huge characteristic that I need in companies that I invest in, because ultimately you want to know that company, it will exist for the next 5 to 10 years, and not that there's going to be a similar company that comes out and has the ability to steal market share because there's actual no advantage in the first company's technology. So for example, when it comes to fintech, I always take this example. Right now, because of demand, there's many companies that are just being incorporated and offering pretty much the same products. So for me, it's very hard to invest in one company due to the fact that I know that others can come out, and who knows what consumers are going to feel in 3 years from now, 4 years from now, and they might shift over to those newer networks that are provided. So it doesn't give me the satisfaction in an investment there. And I actually just sold my fintech because I wanted to buy more Tesla and continue buying Tesla. Anyways, but when it comes to other companies like a Google, like an Amazon, like a Tesla, I kind of see the advantage in these companies, and I don't think that companies can just replicate their technologies. So this is a huge aspect, and sometimes just the network effects is an advantage in itself. So it might not be technological, and it could be just Home Depot. They don't have maybe a technological advantage, but the fact is, when you talk about to any contractor of where you're going, is pretty much Home Depot, even way more than Lowe's. So like that's also to a large extent the real advantage because of how hard it is to build up these locations and all that. So it doesn't have to be technological, but you still want to find that real advantage because we are investing for the longer term. So I think it's extremely important to take these 5 rules into account when you're picking a stock. Ultimately, if you took them into account, you weigh out then why you're invested in a stock, because not every stock will hit exactly on every point. But definitely then when you see the market dropping, you'll be like, wow, okay, it doesn't matter. I picked the stock for these specific reasons, and that's why either now I'm going to buy more or I'm happy to hold. Thank you so much for watching this video. Please like and subscribe. I hope it was helpful, and I will see you in the next video.